Oil is back at the center of the global risk map. After new military action in the Middle East, disrupted shipping, and renewed fear around Gulf energy flows, markets are asking an old question with very modern consequences. Are we looking at another oil shock, or just a brutal scare that fades before it breaks the world economy? That distinction matters, because the last true oil crisis did not just raise fuel prices. It helped drive inflation, stagnation, political upheaval, and a global rewrite of energy strategy. This report is not about empty panic. It is about the transmission chain. How does a regional conflict become higher shipping costs, higher energy prices, tighter central bank policy, weaker growth, and eventually political stress? And just as important, which parts of that old 1970s and 1980s playbook still apply, and which parts do not? The historical warning is real. In the 1970s, oil stopped being just another commodity and became the pressure point of the global system. The OPEC embargo, the Iranian Revolution, and later the Iran-Iraq War helped push energy prices sharply higher. Once that happened, the damage spread far beyond the gas pump. That is why the 1970s still haunt central banks. The issue was never just the headline oil price. The deeper problem was credibility. If households and businesses start believing that inflation will stay high, they change behavior. In the United States, the eventual answer was brutal tightening under Paul Volcker. But this is where the analysis has to become more precise. A modern oil spike is not automatically a 1979 rerun. The structure of the global economy has changed. The world is less energy intensive than it was decades ago. Strategic reserves are larger and more institutionalized. There is also a new layer that did not exist in the same form during the old crisis. Precision strikes, drones, and infrastructure sabotage can now create immediate risk to ports, pipelines, processing facilities, and shipping routes. At the same time, markets can reprice in minutes. That means the economic shock may arrive faster, even if the long-cycle outcome is less catastrophic than the 1970s. The March 10, 2026 EIA outlook captured that logic directly. Military action raised a large risk premium quickly, while the main upside risk remained a prolonged disruption around Hormuz. Then, there is the political layer. A major oil move does not hit an empty system. It lands on top of election cycles, trade disputes, sanctions policy, fiscal stress, and central bank credibility. In the United States, the sensitive question is not just whether oil goes up. It is how an administration reacts if higher energy costs start pushing up inflation expectations, damaging growth, or increasing financing pressure. The analogy is useful, but only if it stays precise. The key distinction is persistence. A short oil spike can hurt. A prolonged shipping and insurance shock is what starts changing policy and behavior. The bottom line is straightforward. Watch shipping risk. Watch inflation expectations. Watch whether the stress becomes systemic.